Welcome everybody. Happy Wednesday. Man, this week is flying by. I'm so excited. Got my wife, my daughter will be going out of town this weekend. I don't think I'm going to join them. They're going to be doing a tour of a college, and so it means I have the house to myself. And I don't know why I'm so excited, but just quiet, just to be able to nothing. So I'm trying to keep all my work caught up, and so far so good. Well, hey, if you just heard that nonsense for the first time, my name is Dustin. I'm a financial advisor with Jazz Wealth Managers. I hope you'll check us out. We do these videos to help you get your dough straight. We are not financial planners, but we help with your retirement investments. We invest for you. We are financial advisors. So if you go to our website, you can actually click on portfolios. You could see our portfolios. We're like the only advisor that posts our performance. How are we doing? Good, bad, or ugly? What's going on out there with the investments? And we explain how our portfolios are built rather than just say, yeah, we got you covered. So we're completely fiduciary. We manage our own portfolios. We got nothing to hide and nothing to sell but ourselves. So I hope you'll check us out there. Well, I want to do an interesting one today. What's better? Should you invest in real estate or should you invest in the stock market? And I get it. People are passionate about this argument, but in reality, numbers are numbers, right? So we need to kind of weigh the numbers. Now, what I'm going to do today is share some charts. Actually, I stole them from Yahoo or Business Insider or Business Math or somebody. We'll show them. But what I'm going to do is make a different argument. The argument is not should you invest in the stock market or should you invest in real estate. The argument is risk. And so I want to talk to you about risk, and I want to talk to you about speed while answering and talking about the question, is it better to invest in the stock market or real estate? So hopefully you learned something. If you do learn something, hit the subscribe button for me. Really helps us out as far as what we're planning to do next year. And so let's get started. Here's the thing. When you invest either in a house or in the stock market, you are taking a said amount of risk. So we're going to call it a risk of X. Oh, we're doing it. We're going X and Y on you today. So you take a risk of X in exchange for, I know this isn't how you do it, but I can't think. You're taking a risk of X in exchange for a potential return, right? So I'm going to leave this kind of small up at the top. Risk return. Almost none of you can identify to me the risk that you're taking in the stock market relative to the return you're getting. See, the wealthy people, the wealthy clients, the people I've dealt with in the past at other companies, they're not interested in, well, did we beat the S&P 500? Oh my gosh, I mean, did we do better? Did we do worse? What happened? They could care less. And they never talk about that. What they care about is total return relative to risk. They want to make sure that if they're shooting for 7%, 9%, 15%, whatever it is, they want to make sure that they're taking the least amount of risk possible to get to the projected goal. So our portfolios on our website, some of them do not beat the market. They're not supposed to. They never will. We will not manage them in a way to beat the market. We are managing them in a way to give someone about half the returns of the market, if that's what's suitable for them. It's not suitable for everybody. If that's what's suitable, we want to get about half the returns of the market using the least amount of risk possible. That's how you do it. So in the stock market, you go, well, I'll just buy the S&P 500. Okay, so you're taking a risk of X in exchange for Y. Fair is fair. Now, what if I told you you could take a risk of X minus 0.5 in exchange for a return of Y? Meaning you invest taking a little bit less risk in exchange for the same return you'd be taking up here. Every one of you should have your hands up saying, amen, throw me in there. Dustin, how'd you do that? I want to do that. Because you're taking less risk for the same return that the general population would be taking on, let's say, like the NASDAQ 100 or whatever the index might be. So the goal is to identify the risk you're taking relative to the return that you're projected to make. Now, what if I said you can have, if you take risk of plus 2, I can give you a return of Y plus 0.5. Sorry, I know we're going back to like middle school math here, but if, this is a 2 by the way, you take 2 times, or not 2 times, but risk that is slightly greater than the average in exchange for a return that is not linear, but it is also slightly better than the average. Would you do that? Would you take that risk? So some of you currently are. I've heard some of the stocks, the portfolios that you are invested in and how things are going. A lot of target date funds right now, unfortunately, are taking a risk of X plus some number, not times. Please don't, it's not a times, that's plus. So X plus some amount in exchange for returns that are not really that much greater than if you just went with returns of X versus Y. Have I lost you guys yet? Talking about X's and Y's sort of messes me up, but I got a great night's sleep last night and had a lot of coffee today, so I'm good. So you wouldn't do this. This one you'd say, I don't think so, bud. This doesn't make sense. If we offered a business model that looked like that, we would not have very many customers. So up here, X minus 0.5 in risk in exchange for a said return. Now what if I could tell you that if you take an X minus 1 risk, I know this is not the appropriate math, but if you do risk of slightly less than this one, and in exchange, you could have essentially Y minus 0.003. Would you do that? Take a lot more risk than this one, but you're going to give up a little bit. Yeah, you would do this one, right? You would totally do it. Anytime you can reduce risk and not give up as much return, you take it. So one of the things we do with our customers is we'll say, hey, if you have a 401k, we want to take a look at it because we want to make sure that you're not in a target date fund with a set amount of risk relative to the potential return. We would rather have you pay slightly more to take less risk for the same amount of return. Even if it costs you like 20 basis points or 10 basis points or something, it's not that big of a deal. We'll also look at it and say, with what you're invested in, are you paying too much for those funds where the growth that you're going to get doesn't make any sense? Meaning you're going to get some kind of growth, but you're just going to pay in those little mutual fund fees anyways. So we'll break that down for you as well. Anyways, going back to this. In the stock market, almost nobody can tell me how much risk they're taking relative to the return. That's sad, because if you buy a house, can we all factor that on a house? What's the risk you're taking by buying a $200,000 house, putting $20,000 down for some reason, because that's the first number I thought of, and you're going to rent it out for, say, $2,000 a month? Me and my twos today, right? We can go through and figure out the risk that you're taking. We've got repairs, we've got upgrades, I get it. We've got potential for vacancy, we got potential for people to not pay the rent, we got expenses to kick people out. We can go through and say, we're taking X amount of risk in exchange for this reward. Appreciation over the long term, if you hold it for 20 years or whatever the time frame is. This one's easy, and for some reason people get excited to calculate it because I think they're bigger numbers. That's my best guess. People look at these and they go, yeah, $2,000 a month, $200,000, and they get excited. In a retirement account, you got to start somewhere. Somebody started by putting $5 or $100 or whatever into their retirement account, and it feels sort of insignificant. So I kind of understand. Okay, so the first part of this class, understand the risk versus the reward that you're taking. If you can't figure it out, shame on you, because you should be able to figure out what you're risking to get the return. Now the young guys, all the young bucks out there are going to be like, hey, but Dustin, you don't beat the S&P 500 and you can't beat the S&P 500. You 100% can. There are many, many people that do. I do not buy the argument where they say, oh, 92% of all advisors don't beat the market. That's because 100% of those advisors are going after grandma and grandpa. They want them because they have all the money. Grandma and grandpa can't take enough risk, so they have to underperform because they're in an income type approach. So all the young guys that look at those studies and go, you suck, right? Some of those advisors are supposed to suck. That's their job. They're looking out for their best interests. Now, can you beat the S&P 500? Of course you can. There's a portfolio right on our website that does it, and we can't lie. We get in big trouble if those numbers are off even by a little bit. So they're accurate. Now, the other thing is, remember that the S&P 500 it's made up. It's just a made up index that people follow, and for some reason everybody follows it. In reality, the S&P 500, the S&P 600 small cap stocks, if you want to beat and outperform all these years, you're in the wrong sector. Those of you looking at the S&P 500, you're looking at the wrong index, because it's the S&P 600 small cap. That's your best index out of the whole entire lifetime of the people tracking these index. We did a whole video on it, so I won't go into that. What I do want to go into is some pictures here. Everybody loves pictures, so let's go. Number one, real estate versus the stock market. If you go back till, since you guys know, maybe some of you don't know, but the tech bubble, go back to the 2000, the whole dot-com bust, maybe you learned about it in school if you're really young, but here's a graph showing in red the stock market's performance relative to the price of homes during, from 2000 till now. What do you notice? You thought I was going to make the argument that the stock market's killer, you got to put all your money in the stock market. Ah, not true. Now, I don't like when people say from this time to this time, this is what happened, because we can cherry pick this time and we can cherry pick this time. So I really like these charts because they went from both the bottom and the top to show you some things. So this one shows you from the top of the tech bubble, not the bottom. Anything looks good when you pick it from the bottom, right? I know I'm going to get a comment on that one. Okay, so take a look at it. The market is essentially just catching up if you look back over that time. And so what's one of the other things that you notice? I'm going to pull this one down. We're going to go to the next one here. What's something that you notice here? Since after the tech bubble, so the first one was at the top of the tech bubble, if for some reason you were able to buy during that dip, then you're doing better. Stocks win the argument here. This is raw cost, by the way. This is not upkeep for the house. This is not maybe trading fees if you buy and sell the markets. This is assuming buy and hold a stock, buy and hold a house, and it doesn't cost you anything, okay? So key point with this study. So this chart here, we're beating housing prices. Now, housing prices, that's not a bad return. I mean, that's pretty good. You'll see that as we look at this, the housing prices returns are not, you know, they're not anything to sneeze at. They're pretty good. It's just the markets have done much better. All right, let me go on to the next one here. Take a look at this one. This is the housing price versus the obviously the returns in houses since the top of what's known as the financial crisis. So when we go back to the top of 2007, right, where does it go to? November of 2007. Now, this is interesting because this one has to do with the housing market. The tech bubble didn't hurt the housing market. You can actually go back and see housing prices kept going up for a while, even when the stock market was falling. So not really that big of a deal. Now we're going to move into that 2008, 9, and 10 category. Uh-oh, now we're affecting houses as well. So this is a really good measurement of the stock market versus housing because both of them took a hit during that time, and both of them have been recovering since then. So, since the top of the financial crisis there, you can see the stock market just outpacing the price of homes. So it's not really like a clear winner in this little time frame. Yeah, I mean, clearly it's the price of stocks, but it's not a, you know, blowout, yes, you have to do it this way, no, you have to do it this way. And I'll point out again, what do you notice about this chart? All the charts I've shown you so far, besides the fact that one line's red and one line's blue, there's a big, big thing sticking out here that almost nobody's going to point out when they look at this study. I'm not going to tell you yet. Okay, let's move on to the next one. So the next one here, what do you notice now? Now this is the housing prices versus the stock market, but housing prices in Miami. What do you notice? Big difference there, right? Not only that, but now volatility, right? Speed. We talk about the speed of your portfolio, the speed of your investments. That's volatility. Look at the blue line there. All of a sudden, Miami is more volatile than the national average. So if you're in Miami, you're investing in Miami, Denver, New York, what else was there? Houston. You're seeing more volatility here, more like the stock market. And that's really the key point that I'm trying to bring up here today. Look at this guy here. This is since 1991. This is the performance of the stock market relative to the price of homes. Or not relative to, in comparison to the price of homes. The price of homes has done well over time. You can't argue that owning a home is a bad investment. Maybe it's just the location, right? You may want more than one home, or maybe you want rental properties or whatever. That makes sense to own the home in raw numbers. But the key thing that I keep saying, what do you see? What are you seeing on every one of these charts? It's the volatility. right? So the stock market, no doubt, beats the housing market in terms of return given from 1991 till now. That's as far back as we can go because of the FHA housing numbers don't go back any further. Obviously, the stock market does, but think about it. More volatility in the stock market. You have to suffer those ups and downs. Look over here. Can I go like this? Look over here. This is your tech bubble. I'm sorry, where are we at here? This is your whole tech bubble in here, the stock market falling. And then you come over here to the housing. No, I'm going the wrong way. Come over here to the housing market, all the way over here, right? You had to suffer some severe declines. What about the housing market? It doesn't look so bad in the grand scheme of things. I mean, in reality, if you owned a home during that last crash there, you felt it. I mean, let's not lie. We all felt our home prices drop. But you get less volatility. So the moral of the story here today is not to pick. I hate the videos on YouTube. Should you invest in real estate or the stock market? No, it all boils down to speed, right? You might have stock market investments. Maybe you have 70% of your net worth in the stock market. Okay, how about 30% goes in real estate in one fashion or another? You don't have to physically buy a house. But what that's going to do is slow your portfolio volatility. Means it's not going to be so scary overall. So while the picture that we just showed was like this of the stock market, right? And then we also had, I showed you the value of homes doing this thing. While you've got this going on in your stock market investments, you've got this going on with your home price investments. In reality, your overall net worth is doing this, right? Is smoothed out because you have a mix of investments. That's the key part, because so many people, they get so emotional. When the stock market falls, I promise you, I'm going to be doing video after video going, please don't take your money out of the market. Come on, guys. Don't pay 30% to take your money out of a 401k. It doesn't make any sense. But people will, because of the emotion of a drop. Because what we talked about in the beginning, they don't understand the risk that they're taking relative to the potential return. This is a significant amount of risk relative to a significant return. But you have to be willing to suffer that, right? Real estate, the risk could be argued that it is less, right? The volatility overall of home prices is pretty stable, right? It's not that big of a deal unless you live in one of those towns where like Walmart was the big employer and Walmart left or something. Other than that, it's not that big of a deal. So if we can smooth out your overall net worth, takes the emotion out of it. If we can take the emotion out of it, you will keep investing and you will keep seeing those returns. There comes a point when someone starts investing from, say, here to here. They could care less about the money in their account. I don't know what it is, but people will put money into a 401k, a Roth IRA, build, and then go, uh-oh, turns out I need the money. And you go, what do you mean you need the money? You're not saving, you don't have your money right? Like you don't have a savings account? And they go, nah, I'm going to take it from here. They don't care. But once the account starts to grow and get bigger, we did a study on this. We showed that the older people don't touch their money because now that number's huge. And those people are going, damn, how do I protect my money? I don't want to touch it. I want to let it grow. Look what it's doing. But so many people will never make it to that phase because of the emotions of the ups and downs. So maybe, just maybe, it's worth it for you to own some kind of real estate, whether it's also using real estate investment trusts, using these new services that are out there where you can participate in real estate, or physically buying a piece of real estate, whether it's your own home, a rental property, a duplex, or something like that. I should say duplexes aren't in this study, but it may make sense emotionally for you. So at the end of the day, the argument is speed and emotion. It's not which one is better. The charts show which ones are better, but I'm not that guy that's going to say you got to invest here or there. You got to invest so that your mind isn't freaking out when home prices fall for some reason and the stock market goes flat, or the stock market falls finally after all this time and home prices keep going up. So you got to have that emotional balance. And I don't mean to sound all soft on you guys today, but it is so true. Emotion is the biggest element that holds people back from everything. So that's it. Brick Station, is it okay to judge portfolio based on consistent past performance? Does this past indication give it, we're not looking at the past? Well, Brick Station, good question. So I should have started this by saying past performance of housing prices and the stock market are not indicative of future returns. Speed is. So how is the portfolio moving? If you can understand that, then you can understand that, well, if the market goes up X, I will see returns of close to Y over the long term. If you don't know the speed of the portfolios that you're invested in, or whatever investment that you have, then all you have is past performance. That's why mutual funds are so horrible, because they only show you what's already happened. They never tell you we're moving at this pace. Hey, stock market's going this fast, we're moving this fast. All you see is a return, so you don't know if they just had a good 3, 4, 5 years or not, or if they really are moving at that speed. So careful. Hey, Bruce. No, it does not discourage diversification. Hopefully, ML, by the end of this, I have encouraged diversification to some degree. REITs and stocks. Perfect, Maximo. I don't know how to say your name, but yes, real estate, super low volatility. You guys got it. I should have been answering these questions the whole way. I love it. Maximo doesn't want to deal with tenants. That's fair. Maybe you own your own house, though. This doesn't mean you have to buy that. You could also invest in real estate investment trusts. You could also invest in companies that go, well, those are REITs, but you can invest with friends or something. I don't know. Whatever's best for you, I'm supposed to say. You invested in real estate during that, yeah. So Nicole, some of us have a little experience, a little bit of extra, lost some hairs, put some wrinkles on the face. I hear you. Yeah, good. So that's perfect. Perfect. Well, I appreciate you guys sort of humoring me during this study today. I hope it helped you in some way. If so, maybe you'll hit the subscribe button. I'm going to be doing a bunch of speeches next year to the industry that have to do with what younger people, and I mean like under 40, are thinking about their investments relative to the studies that you see out there. I've been working on this like nonstop because I think there's a huge mistake here. I think the industry thinks one thing, and all the financial advisors, they're all going this way, and I can completely see by all the data that I have from you guys, all the customers that are joining us here, I can see you guys are going this way, and I think that's why we're doing so well, is because everyone's looking over there, and that's unfortunate. So I want to do a bunch of classes next year and speeches for the industry, and I'm going to need the data. So if you'll hit the subscribe button, I want to be able to show data that shows you guys actually care. I'm going to probably say that 1,000 more times before that. So, all right. Anyways, we got the closing beat coming up later today, 5 o'clock. And I've got another really interesting to talk about. I want to focus on a couple things in the closing beat, and I'm going to give you some stats that you have never seen before when it comes to the crazy investing that some people are doing. We're going to relate it all to stocks as they are performing today, so you can learn in real time on the closing beat. I will see you guys then. I appreciate you watching, and have a great rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.